on, exactly. All right, ready for the recording? Good, okay. 3, 2, 1, let's go. Okay, welcome back everybody to the second part of day one of the 3 Ws. And now what we're going to do, I'm going to be joined shortly by Tom Williams, live from the United Kingdom. Tom has just come out of hospital, so we wish him well, but he's in fine spirit. I just spoke to him earlier, and he's very excited to be joining us. But what I want to do in this session is I want to go through some basics. I'm going to talk a little bit about what is VSA, because there's a lot of new people out there who've joined us on the internet who've literally only found us in the last 4 or 5 weeks. Now, I'm not going to be too redundant, because a lot of you know exactly what VSA is all about. And then I want to give you an actual example, some really good chart examples of shakeouts, which is a really clear, when a market is shaken out, it happens because the professionals are bullish. But a shakeout will happen when the news is bad. Now, that's a real difficult one for many traders to get their head around. The best buy of a stock in 2010 in June was British Petroleum. But if you switched your TV on and said to your wife or husband, honey, I remember that VSA guy said I should buy BP now, and she sees all the bad, or he sees all the bad news coming in, you'd be amazed. People would look at that and say, no way at all. Now, I was at a seminar at Massachusetts Institute of Technology with the Boston Traders Group, and I spotted a shakeout in BP. And it was just after they said we can't cap the well, and that Libya are going to take over. Colonel Gaddafi is going to buy BP, was the story I had. But I looked at the chart, and I thought to myself, hold on a second, something's wrong. I rang Tom up. I said, Tom, your signals can't be right. I said, have you seen the news? He said, yeah, it's terrible. I said, look at the chart. He said, they're buying. He said, they must have capped the well. That's what he said to me. I said, I can't prove that. He said, Gavin, buy. And this was BP at 27. Actually went up to 48, I think it was, in 6 months. Doubled in value. So what I'm going to show you today is one of the things I've learned about being a trader is contrary in what you think. But what is VSA? Well, it's called volume spread analysis. And at its core, volume spread analysis, or VSA, is a methodology based on the original works and teachings, as we know, of Richard DeMille Wyckoff, a trader from the early 1900s, and that's who we're honouring this weekend. The methodology seeks to establish the cause, and I've put that in little ticks there, because the cause is a universal law, the cause of price movement on a chart. The cause is simply the imbalance of supply and demand as the market trades, resulting in strength or weakness in the market being charted. For the correct analysis of volume, you need to understand that the recorded volume contains only half the knowledge required for a correct analysis. The other half of the knowledge is found when observing the spread, or what we call the range, of the price bar, and the closing price on that bar. That's the most important part, the close. Volume indicates the amount of activity on the price bar. Now, I'll repeat that. You might want to write this down. It's something I've got stuck to my computer. Volume is activity, or volume equals activity. But it's the activity of the professional money that we're after. We're not interested, and Tom you'll probably hear him say it, we're not interested in all the retail traders in Chicago or Hong Kong or Singapore or Malaysia. It doesn't matter where they are. The big institutional players that control serious amount, and we're talking billions of dollars, trade the markets every day. We know, we met one of the guys last night from New York. So they exist. We all have heard, who's heard of George Soros? Put your hand up, George Soros? Widely recognised with making £1 billion by attacking the British pound back in 1992. So volume indicates the amount of activity on the price bar, and the spread or the range of the bar shows what the price actually did, and most importantly, where the price finally closed. That is really the essence of VSA. And it's all based on the Wyckoff principles that Gary just discussed. But we have certain terminology in the VSA methodology, and we have signals that are built into a computer by Tom Williams. Tom said to me, you know something, Gav? He said, if Wyckoff was here today, he'd done exactly what I did. He would have computerized his knowledge. That's all Tom has done. But interestingly enough, He's done it, and very few people have been able to copy it. And the ones that have failed. That's because Tom is a genius, like David. You meet people in your life where you know you're in front of them very special, who has intelligence far beyond what you understand. So when I met Tom, one of the things Tom always tells me, he said, "Oh, Gavin, it's so easy. Trading, easy when you read these charts." And I said, "Tom, it's not easy. 90% of retail traders lose money." "Oh, well, they're not looking at charts, Gavin. That's what's the matter." Well, it is. He's got a point. Most traders that lose money overcomplicate the process. They suffer from something called analysis paralysis. Have anyone ever had that? Where you're looking at so many different things and so much information, you've got no idea which way the market's going to go. Gary just made a very valid point in his presentation. He says, "Look, I don't try and go for everything. I keep it. What is the market telling me?" Wyckoff said the same thing. The market unfolds second by second, moment by moment. And it says, he actually said, for anyone that can learn to read the tape, you give yourself a distinct advantage over the general trading public. That was written in one of his books. And so volume is basically at the bottom of this chart here. Most good charting packages contain volume. We, of course, have a charting package with Trade Guider, which shows the volume. Let me ask the audience, if I may, and maybe you can let me know what the answer is. How many of you here use volume currently in your analysis? Yes or no? I hope so. If you've come here and you weren't using volume, it'd be a seriously problem. How many of you currently use volume in your analysis? Let's see what the answers come back. I'd just be interested to see if anyone says no, because a few are. Okay, well, this is great that you're in the right place, because I usually do a lot of seminars with the CME group, the ICE exchange. I'm an educator for the exchanges. When I do webinars in front of 1,000 people, we find that at least 60 to 70% don't use volume. And it's said about 90% lose money in the market, so I'm figuring out why. Volume is honestly, really is the gasoline that drives the markets. So here is my mentor. Obviously, David has mentored Gary. This is my mentor. I was very fortunate to meet Tom over 10 years ago now. It's Thomas George Williams. He was born. Anyone have any idea where Thomas was actually born? Anyone got any ideas? Australia. He was born in Australia. Yeah, he's Welsh by descent, and he was born in 1929. So he says here, if you can read a chart correctly, you will understand the markets do not move randomly, but are moved by the smart money. And you can see their intention at support and resistance levels especially, by looking for the telltale footprints hidden in the volume and price. And then you have a chance to profit by following their footsteps. Volume is vital in your analysis, which is why the self-regulated exchanges around the world will not release the true volume figures until the day after the trading took place. You all know that. The self-regulated exchanges, including the London Stock Exchange, do not give you that actual real volume until the next morning. Why do you think that is? Because they know how valuable it is to a chartist. It's like going to Vegas and knowing you're a card counter. You're not very welcome. In fact, you probably get your kneecaps blown off. I watched a program on it the other day. I mean, a guy was a card counter for years, and eventually they figured him out. He made millions from the casino because he understood how to play the game. Now, being a card counter takes a genius. If you can read volume correctly, you do give yourself an edge. And actually, Richard and I, that's my business partner there, Richard Begnell, we've met some very big players in the market from around the world. One of the top fund managers in Malaysia, I won't mention his name, uses VSA, uses volume. We've seen two guys who are customers winning competitions using volume spread analysis because the markets are not going to change. Someone said to me, Gavin, why on earth are you teaching something that's 140 years old? You're so out of date. You ever heard that people say that? Why are you teaching something 140 years old? It's not relevant now. We've got computers. I mean, they didn't have computers in those days. I said, but hold on a second, you're missing the point. The markets are traded by human beings. And Wyckoff recognised there were certain things going on, and he had a tape reading. That's what he did. They had ticker tape. Well, we've got the same thing now, but it's on a computer screen. So let's go to some basic concepts. This is the S&P. All right. Now, what were we all told, or sorry, what was the general public? I'm going to differentiate us. In this room, I'm going to assume, and you listening on the word, we're going to call us strongholders. Because we're not weak holders, because we're listening into information which makes us strongholders. But listen and think very carefully. Go back to the beginning of August in 2011. what were we all told that the stock market was going to do? Was it going to go up or down based on the US problem? Very widely reported. In fact, I tend to cut newspaper articles out and keep a montage, because then it teaches me, I train my brain. I believe in something called neuro-linguistic programming. Anyone know what that is? NLP. It's training the brain to recognize and assimilate information. There's a problem with that in the market. Most of the information you're going to receive from the media, your friends, your brokers, will be misleading you. It will not help you. Because actually, this is the chart in August. This is the day, these 2 days here, when the US was downgraded. Now, what do you notice, everyone, about the volume on those 2 or 3 days? Yao Ming, it's my favourite basketball player, as we'll hear in a minute. I always look for Yao Ming volume. What do I mean by that? Yao Ming, as you're going to see, one of the great basketball players, and he's retired now. But I always imagine people in a line, and if I'm standing next to Yao Ming, he's going to be up here somewhere. Well, in volume terms, it's what I call a skyscraper. But notice here, it's on a down bar. The price bar is a widespread, closing on the low, just as that announcement comes out. But look at the very next bar. Those 2 bars are a telegram sent to you from the professional side of the market, if you can read it. Most traders I talk to will see that widespread down on the day, on that high volume, and say, well, they have to be selling. They have to be selling. The price fell, the volume's high. Ah, I say. You can't know that until the next bar, which is why VSA doesn't look at 1 bar. There's only a few signals that looks at 1 bar. Very few. I think there's 10. And there's about 300 signals in the software. We look at the next bar. So we look at more than 1 bar. Why? Because if we see selling in that bar, surely the very next day we should close lower, right? There's more selling the day before, we should start to close lower the next day, but we don't. We actually spring. The market closes higher than the 50% bar. So there's my first signal. Something's going on here. Now, would I buy there? No. I don't know that that's the end of that down move yet, but I certainly know that the activity there is very high. So that's my first signal. Now, what tends to happen after you see very high volume? People read Tom's book and my book, and they say, well, we see ultra high volume in a down bar, that means the market's going to go up. But that's not necessarily true. When we see ultra high volume, we know that supply is still around in the market. There must still be some selling in that volume. And the professionals know that too. So they're going to want to test that area in the future, which is why the market doesn't just, well, sometimes there are 2 signals where the market just goes straight up, and we'll talk about those. But usually you see the market do exactly what it does here. It comes back down into that area of where the high volume was, but now the volume gets lower. Can you see? So now they're coming down, and there's not as much selling pressure on the market. And then over here we come down even further on these 2 bars, and we see the same reaction. A widespread down, high volume, but the next bar closes up. By the law of supply and demand, there must be demand coming in. Otherwise, the price will continue to fall. Now, they're very cunning, and you're going to find out why. Smart money are cunning. They see this support level in the background, and they would mark it down one last time and get rid of all the stops. And it's done deliberately, as I'm going to prove to you. In the gold market, it happened 3 times this year, 4 times last year, and I'm going to show you why it happens and how you identify the place to put your stops. Because the problem is, they see the stops. Professional money, you've got different level platforms. They also know where the herd put their stops, usually on round numbers, usually far too close to the market. Most retail traders tell me the reason they can't make it in the market, they keep getting stopped out. Why? Usually they're trading too much size with a short stop, because they think they're taught wrongly by educators, well, you've got to have really tight stops in. That's really good risk management. If you get stopped out 10 out of 10 times, that's not good risk management at all. In fact, you're going to get caned. So now what happens is the volume here picks up, and we spring and we break this most important level here. But look what happens. This over here, for me, was one of the best setups I've seen. We've made a higher low on each of these bars. Now, this was Thanksgiving, I believe. But we noticed there's no volume, even though it was traded. And the next day, when it opened, it pushed much higher on a healthy increase in volume. It wasn't excessive volume, and the market went up to 1400, as we now know. But the news, I was telling everyone in the VSA club, bullish, 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 all the way through till March. S&P strong. But people in the club were saying, but Gavin, no, hold on, we've got the Greece crisis. Greece is about to go down the toilet. I'm saying, well, forget what you hear. You do not know what is going to happen to Greece, and it's not going to, the markets will react to it, trade what you see. So remember, there's two specific rules we must never forget as traders. And it's something that took me a year or two to get my head around, because it seems counterintuitive to what you see. Most people say, well, look, if the price is going up, there must be more buying than selling. And I can tell you, there are times when the price goes up on an increase in volume, and there are more buyers than sellers. But often, when you see very high volume as the price goes up, we see and we look at the spread of the bar to see what's really going on, as I'm going to show you. So when weakness or shorting opportunities appears on a chart, they'll appear on an up bar. That's a price bar that has closed higher than the bar behind it. And this will be on unusually high volume. I'm going to say unusually high. If you look back 50 to 100 bars, and this is much higher than all the others, that's unusually high. If any of you are using Trade Guider, the software actually tells you that. It measures it. It goes back 50 bars, I can tell you that publicly. It looks back, and it certainly says that's ultra high. And it also has got an average volume histogram in there that points out, I don't know if any of you've got Trade Guider, but you've got a salmon-coloured area in the software which shows you that there's unusually high volume. Now, this is where I sort of thought, when I first met Tom, that he was contradicting himself. Because he said, right, Gavin, you see weakness very ultra-high volume up bar. And then you see it on very low volume up bars. And I said, that doesn't make any sense, Tom. You can't be right. It's either one or the other. And he said, no, it's not, it's both. So I said, explain that. It doesn't make sense. He said, well, think about it. What did I just tell you, Gavin, volume is? I said, it's activity. So what is high volume? I said, well, it must be high activity. Okay. So if it's the activity of the professionals in that high volume, they've done something. They've moved the market. Let's say they've sold into that high volume. The herd have seen higher prices. So they want to keep buying because they think it's going to keep going. The market then very often holds its level. After you see high volume, it doesn't just, sometimes you get two-bar reversal, but usually it holds and it comes down a little, but it stays there as the market maker tries to encourage more longs. And sometimes you then see the market, and we were talking to Paul earlier, the market pops up a bit, and the volume is now very low, and that is some professional money just keeping that price at that level, saying, look, can we get anyone else in? But because they're not interested in higher prices, they're not doing anything, so you get very low volume on that bar. But because you've had high volume here, and now you've got low volume at that price level, it's telling you something. They must have sold here, and now they're not interested. This is going to result in falling prices. Now, do I short here? Not really. I tried it on Friday in one of the events, because I'm testing something. It works 50% of the time, you get it right. Do I short over here? This is where Tom probably would. I prefer to short a market as it comes down through the high volume bar, at least 50%, and then go to the no demand. But we'll show you that on a chart in a minute. We'll actually show you that. So remember, what defines a sign of weakness? They're up bars, mostly. There is a couple that are down bars. And remember, an up bar closes higher than the bar behind it. The spread of the bar can be narrow or wide, and both are significant. The closing price, ironically, can close on the high, middle, or low. But we're going to show you why the next bar is important. Volume, as I've just said, can be high on the bar or low on the bar. And this comes into where, how many of you read my second book about sequences of events? Anyone on the internet, Gary, who've read the second book? If not, I'll give you a copy, by the way, if you haven't got it. It's all about sequential setups. In the hedge fund that we're opening, it's all going to be programmed around a sequence of events. The sequence starts with ultra-high volume. Always starts with that because that's where the activity is. And the sequence then looks at, in the next 25 bars, do we have upthrust? If you're going to short this, it's upthrust, no demands, widespread down bar, taking out price support. These are the things that we look for. But remember, supply coming into the market will basically cap any up move. Ultra-high volume up bars are a classic trap by smart money. They're there to lock you into poor trades, and they do often. If professionals have no interest anymore in upside price in a sign of weakness, you get low volume. If professionals are selling into the buying from the herd, then you get the high volume. So do you all understand that concept? That's important before I move on. So high volume, professional money is active. Low volume has now become inactive. So high plus volume shows supply on an up bar. The public or someone's buying. And now the other things that you often hear is, for every buyer there has to be a seller. Rubbish. Absolute rubbish. The market maker can have orders on his books for thousands of contracts that have yet to be satisfied. And that's how they make the market. Everything. It's the most misunderstood concept. I mean, I've had people sit there and go, Gavin, that's completely wrong. No, the market has to be equally balanced. Rubbish. Totally untrue. Market maker could receive a block of orders. It happens in the oil market, which is very manipulated, where actually two institutions, which will remain nameless, actually try to hide their orders and actually got fined last year, or in 2010, because they tried to spread the orders over 2 days, and it was held on the books overnight, which you're not supposed to really do. So this goes on, but don't worry about it, because we're going to make money from it. I mean, don't think we're going to change it. I'm not an evangelist here to tell everyone, oh, we're going to change the way the markets work. Far from it. I absolutely love the fact that the markets have a lot of volatility. So remember, low volume shows no interest from smart money. Here is my favourite signal ever. You ever see this? Right here, and this is on Caterpillar. What do you notice? This is this bar here. What do you notice about the volume? Just shout out. What do you notice? Ultra high. How do I know it's ultra high? Well, actually, TradeGuider actually tells you that down here, but we go into this salmon colour. But I can use my own eyesight. I can say, look, behind me we've got volume. Suddenly, it's there. The second, just tell me what you observe on that bar. That's good. What else? There's a really important. Yeah, that's good. But there's one more important thing. Look at it. Yeah, but look at it. Look at all the other bars behind it. What does that bar do that these bars? It is. What else has it done? Gapped. That's what I'm looking for. It's gapped. This is classic. This is the day of a news event, and the news will be fed to the public the day before that Caterpillar are about to make an announcement. And it's great news. And you'll turn on CNBC, there'll be Jim Cramer hitting his bull, saying, oh, this looks really good. Caterpillar's a big buy, we're expecting great earnings tomorrow. This is going to be good. And the next morning, everyone wakes up, oh, look what's going on. Caterpillar just jumped. It went from, what was it, 67, it's gone up to 72. Oh, my goodness me. I saw Jim Cramer last night saying it was a great buy. Well, I don't want to miss out. I'm going to buy. Because I see the volume coming in. They're all buying. This is wrong. This is completely wrong. Because the clue on that bar, well, we know they can't be buying there, because what happens to the very next bar the next day? That's the gotcha bar. And there's two of them on that chart, that one and that one. What is interesting, this is called the end of a rising market, okay, this signal. And Tom's going to talk about it when we bring him in shortly. And it's his favourite signal. And in fact, his syndicate made a lot of money just with that one. If you take one thing away this weekend with us, and you just look for those signals. Now I can say, without, giving away any secrets here, that our hedge fund software is going to be scanning multiple markets for just that signal on its own. With that. And does it need confirmation? I prefer to wait for the next bar down. But the best signal after that is what Gary talked about earlier. Look. Here and here. Look at the volume. There's no volume. No demand. Why is there no demand? Because we sold back here to the idiots that would buy from us. And the news is always going to be good. And that's the problem with this. It's counterintuitive. Human beings see price rises, and we don't want to miss out on what we think. It just happened in gold. August, as you're going to see. Everyone was told. In fact, I went to an airport, and there was a Coca-Cola machine, vending machine. Next to it was a gold bullion vending machine. Now, when that happens, it's like the housing market. You know you're in trouble. Seriously. You know when I came to America, and my father-in-law wanted to buy a house for my wife and I, and this was, I'd been in America, and I said, something, I don't like this. Something doesn't feel right. And he said, what do you mean? I said, well, flip this house that I'm watching on your American channel here. People are making a lot of money flipping these houses, but I said, what happens when it ends? Oh, son, he said, it's never going to end. Property's a safe bet. And oh, it always has been. Well, benefit hindsight, luckily I didn't buy. I sold my house and I rented. I mean, I'm now sitting in a very good position. Because I could see something was wrong. Now, I missed out on 2 years. I could have made a lot of money. But you never know exactly when it's going to end, but now it's ended. And Tom in his book, if you've read, who's read Master of the Markets, by the way? Who's read? Yeah. He says in the book, quite clearly, a trend goes on a lot longer than you think it will. And I'm hearing people say now, oh, in fact, we met with a realty guy, and he said, oh, that's it now. We're going to be back in a bull market in property. I said, really? I said, I've been hearing that the banks are sitting on inventory that they haven't even released to the market. So how does that work? Same as in States. If you charted it, you can actually chart the market. You can chart the Case-Shiller index. So if you were to chart the Case-Shiller, you would have seen this. The end of a rising market in 2007, 2008. Now you'd be somewhere down here, you'd be seeing no demand. That's your property market all over in England. Right, Richard? Same deal. Doesn't matter whether you're in Europe, it's all the same. The second rule is when strength or opportunities to go long appears in the chart, they will appear on down bars. That's a price bar that has closed lower than the bar behind it. And again, you'll see this on unusually high volume, we call it ultra high, or low volume. Both, again, are relevant. Now, the wonderful thing about VSA is there's a few exceptions, but if you took the signs of weakness and turned them upside down, you'd have the opposite, but just with different names. No demand, no supply. End of a rising market, do we have the end of a falling market? Oh, no, we have bag holding instead. Why? Ask Tom Williams. Our computer programmers in Beverly Hills, 2 great Jewish guys, said to me, Gavin, why didn't you just have the opposite? The end of a rising market, didn't they? They couldn't get it. Surely you have the end of a falling market. Oh, no, Tom wants to call it bag holding. Why? Well, because in his brain he said, well, what the professionals are doing at the bottom is they're opening their bag and catching all the orders from the panicking public that are selling. So, and Philip Friston, who's in here, he's a hedge fund manager in England. Hello to you, by the way, Philip. I saw you logged in. We've had a discussion about the terminology of the assay, which can appear a little misleading to start with, but like the word test. Now, it's in green in most of the software, isn't it? But is a test a sign of strength? Yes or no? Very good. Very good. Excellent. A test. If you go and if you go and drive a car, and you know, Brittany, have you learned to drive yet? You have. So you had a test, did you? Did you have a test? Yes. Did you fail or pass? What, first time? Oh, very good. All right. Well, if you didn't, you could have had 2 results to that test. You could have passed and you could have failed. And that's how tests are. So tests can be both things. So a sign of strength is a down bar usually. We can have signs of strength on up bars, but usually down bars. That's a price bar that closes lower than the bar behind it. A narrow spread bar is really good signal, as I'll show you. Closing in the middle or low, can close on the high as well, actually, I could put there. Volume on these bars can be high or low. Narrow spreads indicates no professional selling there. This buying that's coming in will almost cap any attempt for the market to move down. Ultra high volume down bars, a classic trap. If professionals are no longer interested in lower prices, you'll get low volume. If they're buying, like in the example of British Petroleum, then you're going to get higher volume as the panicking public sell. Now, when I say the public, let me just be clear. It's not just the public that get it wrong. As you're going to read.
Welcome to GoToWebinar, Web Events Made Easy.
It's lost its connection for a second. 2,000 hedge funds or 3,000 hedge funds went out of business. So even they get it wrong. You just need to mute it, that's right. Yeah. So, and then we also see that when you get high volume, that's showing some demand coming in. If the public are selling and professionals think there's a bargain to be had, they're going to buy. And again, low volume shows no interest to the downside. Here is my favourite signal to buy, and it's Tom's as well. Just 1 second, let me just, take it off. Yeah, 1 second a minute, everyone. You press me. Or you can just turn it down. Sorry about that, our backup recording had a bit of a problem there. Okay, so bag holding. What is going on here? Well, again, what you're going to have, when you see bag holding, the following things have to be in place. You have to have a downtrend behind you. So prices will have been falling or declining. You're probably going to see no demand bars like you see here. You're probably going to see upthrust, but the prices will be declining. Next, look at the spread of the bar. Okay, very narrow. It's almost the opposite of the end of a well, it is the opposite of the end of a rising market. Spread is narrow, closing in the middle. They most often do. If it closes on the high, even better. But look at the next bar. This is a setup I'm giving you right here, so really focus on this. If you just take these two setups away with you this weekend, you'll make money. I can't guarantee how much, but if you saw these signals, I would say, if someone said to me, is TraceBible about buy and sell signals? And I'd say no, definitely not. Green does not mean buy, and red does not mean sell, unless it's in a sequence. But these two signals, for me, are as close as we have in the software to buy and sell signals. And again, I'll encourage you to go and find them and see what just don't trade real money, watch what the market does. What I like to do when I see these signals is I like to see something like this straight afterwards. The market comes down to the top of the bar here, and we have a sign of strength coming in. We call that, can anybody have a guess what that's called? Hazard a guess, that signal there. I won't tell you what it is. What's it called? Say that again? Yeah. All got it right. No supply there. Because the market comes back down and there's now no volume because the professionals have bought back here. And as the price comes down a couple of days, they say, hey, we already bought. We think this is a bullish stock. We got this stock at a bargain. So we're happy with that. So we're not going to participate in downward movement. And we know it's a good signal because it's confirmed on the next bar. By the way, that stock went on to rally like something like 350%. So these signals work. I mean, bag holding an end of a rising market, I could write a book just on those two signals because there's plenty of places where you see those on a 5-minute chart on the S&P, you see it on the Dow, you see it on the currencies, and it often moves the market down 10, 20 ticks on a 5-minute chart. If you're trading 20, 30 contracts, that can be a very good trade, depending on what size account you trade. But you can also see these on monthly charts. Like with gold, I saw a signal called a buying climax, which is where it tells me professionals are not interested in higher prices. Right, let me ask a question to the audience. I'll ask you just to put your hands up. Do you think the financial markets are manipulated? Yes or no? I will get everyone here is in agreement, I think. Does everyone here say no? No? Yes? No comment. Okay. What do you think? No. Okay, what can you ask what the audience says? Is there any no's? Okay, it's good. Well, now I'm going to, again, I want you to imagine now that I'm a policeman in court. I'm just going to show you the evidence. Well, look at gold and silver as an example. I showed this last week, and this is very powerful information. How many of you have heard of Andrew Maguire? Yes or no? No? Okay. This is an article from the New York Post. And the story was, and it's a true story, that in 2010, Andrew used to work with Goldman Sachs, contacted the CFTC a few days prior to an event in the silver market, which I'm going to show you. Now, what I'm going to do, this is not a conspiracy theory here at all. I'm going to show you the actual VSA chart of what happened, because that's all we're interested in. So here, the story said that there's no silver lining to the activities of JP Morgan and HSBC in the precious metals markets. And it goes on to talk about, I'm not going to read the whole article, you've got a copy of it if you can see it. This is, however, the actual email that was sent to the CFTC. And in it, Andrew describes, most importantly, two scenarios based around numbers coming out, unemployment numbers. And he describes exactly how the market will move before it moves, okay, and will describe what they're going to do. What is going on here, by the way, is they're going to do exactly what I mentioned right at the beginning. They're going to market through previous support areas and then buy it all back for a profit, having taken out all the stops. That's a very profitable game, by the way. So he says here, scenario one, the news is bad, employment is worse. This will have a bullish effect on gold and silver as the US dollar weakens and the precious metals draw bids, spiking them higher. This will be sold into within a very short time, 1 to 5 minutes, with thousands of new short contracts being added, overcoming any new bids and spiking the precious metals down hard, targeting key technical support levels. Scenario two, the news is good. This is what actually happened. Employment is better than expected. This will result in a massive short position being instigated almost immediately, with no move up. This will not initially be liquidation of long positions, but will result in stops being triggered, again targeting key support levels in the past. Both scenarios will spell an attempt by the two main short holders to illegally drive the market down and reap very large profits. Locals, such as myself, will be invited on board, which will further add downward pressure. The question I would expect you to ask is, who is behind the sudden selling, and is the entity or entities holding a concentrated position? How is it possible for me to know what will occur days before it will happen? Only if a market is manipulated could this possibly occur. Now, that was fairly well reported. You're never going to see that on CNBC. You're never going to see that on CNN because it's not palatable. People don't like to see that. But let me tell you, if you want to be a professional trader and make money in these markets, you've got to understand the game we're playing. And I was asked it a few weeks ago, Gavin, you do education for the exchanges. Surely they don't like you talking about this sort of stuff. I said, sure they do, because they want people to trade and make money. They do not want people blowing their accounts out. People think that the last thing the exchanges around the world want is for people to blow their accounts up. It's not good for business. It's not good for the reputation of the market. But the good news is this. We can see, as trade VSA, what's going on, and that gives us an edge. This is an article actually from, it's the only time I think on the mainstream media I've actually seen this reported. This is 2010. The headline was, "Everyday investors wonder if the market's rigged." So already, because of things that have gone on, the public are waking up. The public are waking up. And that makes my job easier than it did 5 years ago when no one wanted to hear this. So my job is made easier. Now, who's heard of Richard Ney, that gentleman there? Anyone? Anyone ever read his books? Richard Ney. Great, great, great guy. He, again, have you heard of Ney? David?
Yeah.
Oh, you've heard of him. So he wrote a book, well, 2 books, that's 3 books. But I've got 3 of the books. And in it, he says, in which it is shown that if you scrap traditional approaches to the market and attack the financial conspiracy, as he called it, with its own weapons, you can beat the stock exchange insiders at their own game. You can. But you've got to know what the chart tells us. Have a look at Richard Ney's. This is his Rolls Royce. Can you all read his number plate? It's a real number plate. Yeah, wake up. And that was, and he was an investor that was, he was previously an actor and became an investor. So why then, as I'm about to show you, is this ultra-high volume bar so important? Because if a market's being manipulated, you're going to see the activity in the volume. And remember, it will often mark a top or a bottom of the market, warning you that a trade is going to set up against what I call the herd. And I'll define the herd as the uninformed trader or investor, and it includes funds as well, who don't quite know what the game is. So ultra-high volume up and down bars, they're the first alert that a VSA sequence is setting up. But how do we see ultra-high volume? Now, we've got scanners that can go and scan for it, but there's something much better that we can use to see it. Our eyes. That's it. Gary, you use your eyes? David, that's what you use. You eyeball it. It's what most chartists do. We don't tend to get too into, I mean, scanners are useful. I mean, this is an example here of a stock. Look at the volume here. We use our eyes. We say, hold on a second. Wow. Look at that ultra-high volume bar. What is going on? When I first moved to Chicago, I don't know what it is. Brittany, they say all the time, they come in, what's going on? What's going on? It's an American thing here. So now when I see an ultra-high volume bar, I say, what's going on? What's going on? What I now want proof of is what is going on. And the proof comes over the next few bars. The proof comes from the chart. Now, what is a Yao Ming bar? It's a skyscraper bar. It's an ultra-high volume bar. I mean, how tall are you, Gary? About 6 foot? 5 foot? 5'10". David, how tall are you? 6 feet. So I'm about 6'2". So here, these are the average size of a human being. But if we see Yao Ming on our chart, or we see Yao Ming in the street, 7'6". Have you heard of him? Yao Ming. Great, great player. So if he was standing in a line, we're all standing in a line here, he's going to stand out from the crowd big time. Okay, this is the silver chart from the time, the very day that Andrew reported that the market was going to be manipulated. Now, what do you notice, everyone, about the volume on these 2 days? Both prior, which takes out the support, and then when they buy it back. What do you notice? Tell me. Down bar, massive volume. Now look at this first bar. This is the day, okay, that he mentioned here. Look at the widespread down the day before where they brought it all back when the news came out. It takes out all the price support. That there was key silver technical support. So if you're a technical chartist and you had your key support level, so it's not going to go through that, wrong, which is why I'm very skeptical of technical support levels. Because sometimes they work, sometimes they don't. And you don't know. This is why I tend to always, when you're around news events, how many of you here trade on the news? Anyone? You? I don't know how you find that. I keep away. It's not good for my heart. I tend to wait for after the news has come out, because usually they'll mark it the very opposite direction as to what, in fact, in this instance, that's exactly what happened. They marked it down. Now, this signal, can anyone tell me what that is, what we call it in BSA? Anyone? What do we call it? Close. Close. Think of it. So if I turned you upside down, if you had coins in your pockets and I shook you like that, what would happen? All the money would come out. Yeah. So what's that then? Well, think about it. Right. It's a widespread. Now imagine you've got. I'll give you a clue. You've got a pocket full of coins, yeah. And I take you upside down and I shake you like this, and all the coins fall out. Well done. That's what it is. It's a shakeout. It's exactly what it is. It is. It's got string, exactly. It's a shakeout of the market. That's exactly what's happening here. This is the key area. You see that green signal there? That signal there, and that signal there. Because the market had bounced off it, the silver had bounced off it 3 times, as Andrew said in his email, there's already a strong technical support area. In order to get through that area, they've got to get the locals and the big, they've all got to get them together and push it through it, hence the volume. This is the day that the market was manipulated. He told us 2 days before. When I showed Andrew the chart, he went, because you can see it. And the best part is look at the next bar here. This is confirming the shakeouts worked. But even then, I wouldn't buy there. That's where you buy. There or there. Can anyone tell me why? Nope. I want you to look very closely at this price spread of the bar, right? Look at the range of the bar, the high and the low of the bar. The volume is high, the bar behind it's high, but that there is important because unlike this bar, this next bar closes up. But I wouldn't buy there. This is where I would buy there or there. Can you tell me why? Put your hand up, yeah, go on. Very close, very close. The gentleman about it said it proved it's going up. That's a very good point that you just made. Now think of the universal laws that drive these markets. Supply and demand, cause and effect, effort versus result. Yeah? Once I see that very high volume coming in, ultra high, the activity is massive. We now happen to know through Andrew who was doing it. But forget who that is. What makes that bar interesting, as I'm about to show you, is a trigger number. A trigger number is where you say, I've got to buy, or I've got to sell. And I haven't written a lot about this. You're going to see this more in this presentation than I've ever talked about, because most people don't know where the trigger is. But there's a very good reason, as I'm about to show you, that right the way up that uptrend, there were several entries. Now, you alluded to this, Gary, with when you were talking about an uptrend after climactic action. It pulls back on low volume. Okay, now look what happens here as it pulls back. The volume dies down. Look at the volume pull back, dies down, low volume. So what I'm looking at is very simple in my VSA sequence. Part 1 of the sequence. Show me professional money, give me your telegram. What up to? Here, we clearly must be buying because the next bar's up. Because the trend is against me, I don't know. It's like catching the falling knife. It could mark it down further. But if it's bullish, what will tend to happen, as I'm about to show you, you get the shakeout, which is a very key signal. I mean, go and look for shakeouts. They happen all the time in stocks, futures, Forex, commodities. But, you know, there's the picture, look. The shakeout does exactly that. It shakes the money out of your pocket. It frightens people. It gets rid of it. But what we noticed here Just as Andrew Maguire predicted, 2 days before it happens, we see Yao Ming, and we have a trade guide signal. Okay, we can see it right there. SOS, by the way, does not mean save our souls, although you think it would as the market fell. If you're long, you're in trouble there. But it means sign of strength, just to be clear. And SOW is not a female pig, it's a sign of weakness, simple as that. So here we have a sign of strength. The price is marked down, it's taken out all prior support, and then it's bought back at lower prices because professional money here. Can anyone tell me what the price of silver went up to after this? Anyone hazard a guess? Well done. Why? Why 50? Brilliant. Well done. Yeah, brilliant. That's exactly what happened. Now, I said this to someone a few weeks ago. I said, yeah, well, silver went up to 50 because that's where it was in 1981. They said, don't be so stupid. We've got inflation. I mean, silver could not, it must be much higher than that. No. Silver went to $50. In fact, just a few cents before, the Hunt brothers cornered the market. Well known, well reported. And then right at that level, they lost a lot of money as it collapsed. There you go. And just so you know, Jack said here that basically the rule back in 1981 is they actually came in because everyone was short at the time and it was kept going up. They said, well, you can only now sell, you can't buy. And as a result, it bang, down it went. Exactly. But the key is what, sorry? Liquidation only, says David. Yeah, absolutely. Liquidation only. So the trigger number, what is it? It's a place to pounce. One of the biggest reasons traders kick themselves all the time, indecision. They don't make the decision. Now, I was guilty of that myself the first few months of trading. So I began to think of what happens if you pull the trigger. In a gun, it's going to go bang. Well, in a market, you're going to be in the market. Okay, you're pushing a button. It's so easy to place a trade in the market right now. A monkey can do it. Anyone can do it. You could just go in, and that's why there's a lot of gamblers in the market. I've met a lot of gamblers. I don't consider any of you here to be gamblers. I hope you're not, because you're here to learn. And a lot of people treat trading as Vegas. So they just think, they get excited, I just put an order in. I've seen people do this. And I've seen people lose a lot of money because of it. But trigger number is a logical reason to take a trade. Because your brain has said, I can see X here, ultra high volume. I can see Y here, no supply. I can see point here, I'm making higher lows on the bar. I've got 3 reasons to go long. So a trigger number gives you the reason to pull the trigger. After the shakedown, here's what you do. You mark either, now there's 3 points you can mark. The top of the very high volume bar for me is the one I look at. So the highest volume that I've seen, I mark the top of the bar. Why do I do that? Very simple. We've got something called effort versus result, supply and demand, and cause and effect. I know that if the effort here is to buy, and there's no sellers down there, the price is going to go through the top of that very high volume bar. And once it does, as it happens, it's going to change the trend. Trade Guider does it by putting the diamonds on. I usually wait for 3 green diamonds on the daily chart, but I won't touch and even consider a long trade until the top of that very high volume bar has been removed. Next, what I look for is a pullback, and we actually get signals all the way up here, all the way along. Notice the market never comes back down through that line. It's a great place to put a stop, a few ticks below that line. Because if it does get marked back down, sometimes it does. Don't get me wrong, I mean, there are other examples where they will mark it back down to that level. But on that sort of volume, in fact, silver continued to rally massively. So we look for these triggers, but key to it, as Gary showed you earlier, this is now a VSA point of view, the shakeout is the climactic bar that Gary described. It then begins its change of behaviour that we talked about, and then it pulls back on very light volume. Not once, but several times. And the market is making new lower highs. Lower high, lower high, lower high. So it's actually showing me, it's telling them that the smart money here have built a cause for the market to move up. Wyckoff talks about this all the time. For a market to go up after a down move, it needs to build a cause. Some causes are built very quickly, like this one. A lot of them in stocks. Bob, I know you said you're a stock trader. When you see stocks, they tend to do this. They fall, climactic action, test, retest, 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 all one, another retest, and then they build their calls. But if you watch that bar there, and you might wait 4 months for an entry, and then suddenly the market goes above that top bar, look for your no supply, because that then is proving you've built the cause. Tom Williams, I don't know if you've heard, David, have you heard the expression churning the market? Churning it. That's what they did. The syndicate did it all the time. They churned the market. So a shakeout, when we see it, wait. Don't rush in. What I look for after a shakeout is for the market to move above that level, and then there is the signal that completes my sequence, the test after the shakeout. And they're all numbered. So the numbers are there for a reason. In my second book, I've given you some of the sequences I use. And they work. Because everything I'm showing you here may well have been in hindsight, but I do it in foresight all the time. So they are there. The question is, at the time you see them, are you going to take the trade? And that's the wonderful thing about trading. I do not know your individual personalities. I've just met you. I do not know, or I've met Paul before, but I don't know your risk tolerance. I don't know whether you're trading a $20 million account or a $2,000 account. So for me to be able to tell a group of people this is the best way, and most educators say this is the best way, only this way. Wrong. We give you the tools to read the chart, and then you adapt your personality style according to that. And I found from the successful traders like Steve, who's a customer, like Earl, Tim, the others, they found that they've adapted what Tom said to their own style and personality, and I encourage you to do the same. So, always be contrarian. Okay? Chart will never lie to you once you read it. Remember, in August 2011, US downgrade by S&P, buy gold, sell stocks. That's what we were told to do. The fact is that, unfortunately, as we now know, gold hit a 6-month line straight afterwards. Fact. I'm not making this stuff up. I still ask people now, so what about gold? It's very bullish, Gary. Yeah, very, very bullish. Well, bullish because they're programmed from what they heard. They said, no, everyone's buying gold. Gold has dropped, it's made a 6-month low. But the news you read, I'm going to show you something in a minute I found last night, which is not in your sheet. I fell off, well, Richard here, I fell off my chair laughing when I saw it. I said, I've got to put this in. Talk about, the media, the way they put the market, it married to 1400, went above 1400. Fact. If you don't read the newspaper, you're uninformed. If you do read the newspaper, you're misinformed, says Mark Twain. There's probably a lot of truth in that, as I now know. Now, being an ex-policeman, I can assure you, it took me a few years to reprogram my brain to understand the truth, because I come from the system. I'm a system man. Don't get me wrong, I joined the police to help people, and that's but when I got in there, it was a different world, I have to admit. But I didn't leave voluntarily. I was actually injured on duty. I probably still would be doing that. So when I talked to Tom and he said the market's limited, I said, no, they're not. We've got authorities. It's rubbish. And then I started to talk to my friends in the City of London who said, oh, you're inside. You know, and you're a policeman, you now know what's going on. And of course I know, because now I've proved it to myself. Everything I learn, I have a brain that says I need proof. And there's no point in telling me something and say, oh, Gavin, this and that. I have to prove it. So then I showed you the Maguire thing. For me, that's proof. And I had the benefit of, he wouldn't talk to the media, but Richard, didn't we? We had a nice Skype call with Andrew for a long period of time, and he told me the truth. And at that point, I was able to discern for myself that if I want to win in this game, I better start waking up, as Wyckoff said. And I did. And then the truth comes out in the New York Times 7 weeks after. We were told to buy gold. The headline, a gold rush reigns as hedge funds sell. The headline there, perfect for my next book, is the smart money fleeing gold. That's going to be my next book title, I think, especially when gold gets to 1,000, if it does. Yes, of course they were selling gold. We know because we can read a chart. This is the chart of gold. And I have to, you may have seen this before, but look at the ultra-high volume on that bar. It's the highest we've seen for years. But the key to it is to look at the very next month. Look at the September bar. If that bar there is not going to disappear from the chart, okay, that selling in that bar is not just going to disappear overnight, is it, Gary? Because supply is now present. And to go up through that is going to take a hell of a lot of effort, and I don't see it. In fact, consistently, the level I gave on YouTube was 15.55. Gold hit that 28th of December 2011. Yet again, because I did YouTube, there was some nasty emails saying, you know, people don't like it if you do a prediction, it becomes right and they're long. People who took shorts, I'm their best friend. In fact, several of them are coming to Heathrow when we do the London event. Because, you know, this is real. Look at the name of the signal. Sign of weakness 90. Possible hidden selling. And the next bar, and I could see, guess what? Can anyone tell me on the daily chart what the signal was where they began to sell heavily? Have a guess. I've already talked about it this morning. The end of something. That's it. It was on the daily. Yep. End of a rising market followed by an upthrust on the daily gold chart. It was very obvious as well. So we warn investors in advance of the impending gold decline. And there's the video that I did. It had more views than that. You know, it had about 1,800 views. But that was actually filmed, as you can see, just so you know that we do this stuff in advance, not in hindsight. Because Gary, we have a lot of trouble, don't we, sometimes, as educators, and David's the same. If we do something in hindsight, anyone can do that in hindsight. But I've realised YouTube's a great medium to do it before it happens and then go back and say, well, we did tell you. And there it is, August the 25th, 2011, and my headline was, in fact, the gold here is being manipulated and I think it's going to come down. Now, here's a great one. You've got to laugh at this. This was taken from the BBC News website last night. Sorry, this isn't in your slide handouts. But the news, this is from BBC News Business. Okay? Spain bailout talks imminent. So Greece has gone now, apparently. It's now Spain. And next it will be England, or so, I don't know where they're going to go next. I don't know. But whatever it is, the news is there that they're all having these talks. The safe haven was apparently gold, wasn't it? That's a really good safe haven. So I read this and I loved it a lot. So they talk about oil as well. I've also been shorting oil. Oil's a really good short. And I think, you know, when you look at oil, I think we've got a very big opportunity at the moment to buy. Because I think it's found a key support level. And next week I'll know. I haven't got evidence yet, but it could be there. But so it said oil prices hit a 17-month low, which it did. But then we see the bear market come in. And what do we find here? Gold. They've got music on next. Oh, they've got. Well, don't worry. When we go to lunch, we've got the other room because they said there might be a party in there. So yeah, we just had some music hit us in the background here. So, but look at the headline here. Gold, the traditional safe haven for investors fleeing volatile stock markets and fragile banks, has fared better. It's down 14%. It's fared better. What a load of rubbish. It's down 14.14%, which is terrible. Just bear with us a second. I think Richard's going to get the music switched off for a second. Just so you know, everybody, by the way, we are going to move rooms probably because there's a party in there back to the one we originally had. Because this was a temporary measure. So you may have to put up with that for a few minutes, but they'll fix it. So when you see that, I look at this and always the same. You turn it right off. That'd be good. Great, thanks. Yeah, so we see here, the headline here was an oracle of oil. Some of you see this, so I'll go through it quickly. But this was 2008, and again it was the same story. Oil was now going to spike. Okay, now Arjun Murthy was in fact a Goldman Sachs analyst that mentioned this and discussed this. And what I noticed on the chart was as this news was coming out, the weekly chart was going up, but can anyone guess what happened to the volume as it kept going up? It's completely, now this is where low volume on up bars, especially on bigger time frames, tell you that professionals must have been withdrawing their interest. And actually, I then noticed there was a very high volume weekly bar in the background. They've been, and I now know that some banks, which will remain nameless, began to sell it, while the airlines were hedging the wrong way. Anybody know which airline got it right? Oh, I'll tell you what, not many people knew that, I'm surprised. Exactly right. The audience here all pretty much got it. One airline, and I have to say they're my favourite airline, Southwest, you know, for travelling around America. They've always got a good sense of humour and great. But Southwest got it right. And yeah, it could be. Was it Delta? Well, of course, think about what the biggest cost for an airline is fuel. And Qantas have just made an announcement. They lost 90% of profit So they reported a massive warning. And guess what? One of our customers sent me the chart and said, are they buying it? Because it was a widespread down. And actually, I looked at the chart and we both said, didn't we, Gareth? Don't buy that. They could be out of business in a year. Because sometimes you see the ultra-high volume on the down bar, there's no evidence that that's buying yet. And in fact, it could keep going. One particular UK stock did, HMB. We saw ultra-high volume come in. It never rallied above the top of the bar, and it just kept going and going and going and going. And it's going to go to zero, very likely. People seem to think with stocks, especially, that if you buy at a lower price, it's a bargain. And there are times that it is. BP definitely was. But you've got to have the evidence on the chart. Don't assume that every ultra-high volume down bar is professionals buying. They can be selling, especially if they take out price support levels and the market goes back up on no demand all the time. That's going to keep going. But the chart never lies. And we see here that we now know that during that time, the market, again, it was reported in the Financial Times, it was reported, I think, in the US, that there was a large group of funds that were manipulating the oil price. Of course they were. They were encouraging longs while they were shorting. And again, I did a YouTube video in July of that year, warning that weaknesses appeared in oil, and I... Well done, 34 bucks. But hold on. The analyst told me there's a super spike coming soon. You're starting to figure this stuff out. The news is very cleverly put out. It's not necessarily that they're right or wrong. It's that they're inferring something because they're an expert in something, but the only expert that you can trust is not me, it's not Tom, it's not David, it's not Gary, it's not even Steve. It's the chart. The chart is your expert. You are the expert. The chart is your guide. And I don't let anyone tell me what the market's going to do. I will explain what I think the market will do. I only look at the chart as my guide. The fact is, you did this, Jack, plummeted down to $33.60. And the news, and who's heard of T. Boone Pickens? He was telling everyone to go long, and there were so many others. Hilarious. And one stupid little Englishman, an ex-policeman, goes on YouTube, and everyone, oh, you should see the emails I got. I would love to publish them. I really would. There's too many swear words in them to publish them. It really is. But people get very angry when you're saying the opposite. And then, funnily enough, the emails dried up when it got down to about 100. Yeah, yeah, exactly. Exactly that. And in another example here, we find silver, just again massively plummeted in 2011. How many? I don't know. How many of you trade commodities? Okay. So silver, we showed in Trade Guide a scanner a week before it plummeted that they were distributing. They already were distributing this commodity before the plummet. How do I know that? This is the end of day program Trade Guide, and in it we've got the scanner. What it looks for is signs of weakness in a cluster. No worries. So we see this massive cluster of red indicators coming in here, 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 here on the July silver contract. Now, I don't see hardly any strength, so I go and look at the chart. What do I see? Prior to the decline, at point A, what do you notice about the volume? Yao Ming again. Point B, high volume, so they're called an upthrust. So they're upthrust, so they're distributing a week before the decline. So imagine if you see this. Now the C is the final part of the puzzle. You've now got no demand. That happens within 5 bars. Again, if you ever see that, get ready to make money. That is a shorting opportunity. They come about once every 2 months. And guess what? The scanner picks them up. And guess what? The hedge fund, that's what we're looking for. Of course we are. But what I love about, what do you notice about point A that I think is the most important point of the bar? What do you think is the most important point? Well done. Absolutely correct. Several people have shouted out the close. Why? Because it closes below the 50% level. Only one thing what can cause that. Only one thing can cause that. Supply is overcoming demand. It's the only thing that can cause that. Meaning, for every order, because silver, the news was that silver was going up. It was going to get higher. It was going to breach its level of 50, which was the hunt level. But of course, that was the news. The fact was this bar here, which gapped up a little bit, actually, on the, it was a slight gap. But what we saw was the close on the low. As soon as I saw that, and Trade Guide picked it up very well, there must have been supply overcoming demand. And then there we go. There is the chart. That's what we call, that was the weekly. This is the weekly chart of silver. The week before the decline, a big red signal, okay, supply has entered the market, and then we have end of a rising market. That's what it looks like. Fresh high ground, narrow spread, ultra high volume. We scan for these. We can find these. Yeah, it's not difficult to do. But they don't, let me just warn you, they don't come up very often, which is why you might see these on the weekly chart once or twice a week. So, okay, yeah, I'm going to bring Tom in right now, actually. So we've got 2 minutes. Okay, that's cool. These charts, if you see these signals on a weekly chart, start getting really, really excited because you're going to know something now that everyone. Most people will tell you that it's going to go higher. Start looking at the chart. This particular signal, as I'm about to bring Tom in now, will tell you is one of his favourites. So let me just see if Tom's in the actual room here, and then what we'll do. First and foremost, what I need to do is actually go through there. So let me see. Can you put the? Just bear with me a sec while I set this up.
Hello, Gavin, Tom here. I'm in the room. I'm in the room.
Well, just so you know, this is going to be a bit more interesting. About 30 minutes. We're going to break it from 12 to lunch anyway. And then we'll probably move over to the other room if there's a lot of noise. All right, okay, Tom, sounds great. Okay, Tom, can you hear me? Testing 1, 2, 3.
I'm here, Gavin.
Okay, Master, we're just going to set you up on the big speaker here so everyone can hear you. So give me a couple of minutes here while we set this up. And,
Sure, no problem.
Yeah, did that come out? Okay. All right, won't be a sec, Tom. Okay, let's do a quick sound check. Testing 1, 2, 3. Testing 1, 2, 3. Testing 1, 2, 3. Testing 1, 2, 3. Okay, we're just going to test this microphone here, so it won't be a second. Okay, Tom, we're going to be ready for you in about 1 minute here. I'm just going to set up the connection. Okay, let's just do a quick sound check. Testing 1, 2, 3. Testing 1, 2, 3. Can everyone hear me okay now? Before I bring testing 1, 2, 3. Testing 1, 2, 3. Okay, good, perfectly. Excellent. Okay, good. All right, let's just put Steve on for a second while I just set up the speaker, and we're good to go. Just say hello to everybody.
Good morning, afternoon, evening. How's everyone doing? We're dialing everything in here for so everybody can hear everything. Hey, Lean. Hi, Mark. Hey, Brian. Nice to see everybody in here. Hope everybody's enjoying the day. A lot of excellent stuff coming up. It's loud and clear. Nice to see you in here, Steve. You enjoying beautiful Honolulu? We'll be good stuff. Good stuff. Yeah, we'll be rolling here along pretty soon. Getting Tom all dialed in.
Is that coming through the headset? Okay.
Yeah, that sounds good. I can't hear you at all. But everybody can hear pretty well in here. Looking forward to the afternoon session as well. Yeah, you were in the trading room back in September and October. I remember you. Yeah, it's good stuff.
Okay, do another sound check.
Check 1, 2. We're doing another sound check here. So if you hear me saying check 1, 2, check, check, check. Check, please. Check 1, 2, buckle my shoe. Sing a song. No, good morning, Fiona. Yeah, you guys would all leave if I sang. Yeah. Hey, Dusty, how's it going? Sing a song. I'm a little, well. You want to carry it over there?
Yeah, that's probably going to work.
Excellent, Eileen. I didn't break the door down, so that was a good thing.
Let's just mute it. So we're going to mute for a second.
We're going to mute for a second.
Welcome to GoToWebinar, Web Events Made Easy.
A quick sound check. Testing 1, 2, 3. Perfect. Right, Master, do you want to come and do a quick sound check?
Yes, Gary, I'm here. Tom Williams speaking to you from the UK. Can you all hear me?
Crystal clear.
Crystal clear. Good show. So as soon as Gavin says, okay, I will start.
Just one. Yeah, okay, Tom, one more sound check.
Okay, yeah, Tom Williams here. Can you hear me, Gavin? Tom Williams speaking to you from Worthing.
The stage is yours, Master.
The stage is mine. Yeah, well, I always call you the ringmaster, so I have to wait for you to crack the whip and give the okay. And I can talk now, can I?
Yeah, go ahead, Tom.
Okay. Okay. Now, I must admit, I don't religiously sit here and listen to all your speakers talking. I hear you've got, of course, you've got Gavin, you've got Gary Dayton, and several others there. Now, I don't sit here listening to them religiously, so I'm not quite sure. I'm not worried about what they say, because we all talk the same language, and that's a language that was laid out to us by Richard D. Wyckoff over 100 years ago. Carry on, right, okay. So we all speak the same language, and I may put things slightly different. Good. I don't have time to sort of listen to everybody talking here, but you can be rest assured that anybody Gavin presents knows his stuff, knows his business, and I know that because I have listened to people. Now, the reason I mention that is, of course, we've got now the benefit of computerization. Now, Richard D. Wyckoff, of course, never had a computer at his disposal, but I'm sure he would have gone along a similar path if he had. And the fact is that we have automatic signals appearing, which I always say look uncannily accurate. Now, we've got a chart up now of a 15-minute chart. Friday, would it, Richard? Yeah. Now, the reason I mention this is because if you look at these signals, they are automatic. They appear without the intervention of human beings at all. Now that tells us, that top one there, that we've got supply coming in, right? Now we know the market works on supply and demand. So supply is swamping the demand, and you will get sudden lower prices, right? So what I'm saying is, I'm not glorifying the signals. What I'm saying is that if these signals come up automatically, and they are what I call uncannily accurate, then that means in turn that we must have instructed the computer that has no mind, it has no soul, it has nothing. It just simply does what you tell it to in the form of programming language. And therefore, if the signals look good to you, then the information that we must have fed in, the information that we're giving you, right, must be reasonably the way markets really work. And this gives you all the confidence in the world. You're not wasting your time. It's not some guy on a website telling you they have secrets that nobody else has and all this nonsense. And you've got to pay $5,000 to attend the course before they tell you what the secret is. You are being groomed for a con. And you can be rest assured. But this, we never do that at all. We don't have any secrets because we tell you exactly how these signals are generated. When you put the cursor over a signal, you press F1, look, and lo and behold, this dialog box comes up, right? And if you read these dialog boxes carefully, right, so we don't have any secrets. We're telling you the secrets. That's why Gavin always says the chart cannot lie to you. It's there. And the same thing with a computer. Unless you give the computer in the form of a programming language the right information, it's not going to come up with anything that looks any good at all. It'll be just gambling, chance, and it's certainly not based on any mathematical formulas at all. The market, it's been shown many, many times, does not respect or does not have to respect so-called mathematical formulas. And I have, of course, pet theory about mathematical formulas, that you may see a mathematical formula that looks pretty good in hindsight. But keep in mind that if there was a genuine mathematical formula out there that worked every time, then the big money, or even you, would be onto that immediately. And the fact is, as soon as it started, you would be trading it. It would dilute the formula, and you wouldn't have the full formula there in the first place. That's what I think. And the formulas, a lot of them only look fairly good because in hindsight haven't been traded sufficiently. But here, these signals that we have, they come up automatically at the live edge of a market. Now, this one here tells us we don't like to give you instructions, so we use the word potential, right? So it's like the weather forecast said, potential rain. You know, it looks like stopping volume, right? And usually it's correct. Now, stopping volume, of course, is a sudden surge in volume. You can't see that very well because it's Globex. But the fact is it's plummeted down here. The computer spotted it. It's closed in the middle, look. The volume must have increased, and that came up with what we call stopping volume. And we know, when you hear Gavin talking about smart money, it's not necessary, well, it is the smart money, but the smart money is traders that can hit the market with 4,000 or 5,000 contracts or more, and they follow each other, a lot of them. So you have this vast amounts of money coming and going, which alters the balance of supply and demand. And when they come into the market like this, don't forget, it's a principle here that big money, imagine if you are a professional trader and you've got 5,000, you want to put 5,000 contracts in, you cannot buy as the market's moving up. You have to buy as the market's falling. And of course the market falls, usually on bad news and all this sort of stuff. So that's why you've got to be cagey with the news, but that's stopping volume. And it's a very, very sure sign the professional money have moved into the market. So that's what you're looking at right there. Right? So professional money is the sort of money that will trade 4,000 or 5,000 contracts, and they're doing all sorts of things. They're buying options, selling options. Some are trading cash, and some are trading the futures. But they're all trading the market, all this money that comes in. And, of course, they're covering any short positions that they had from the 4 to the top. Of course, this is more or less, this is a 15-minute chart. So we're more or less trading here on a small time scale. Some people might call it scalping. And this is the most difficult thing in the world to trade, scalping like this, where you can make money on these short moves up and down like this. And but once you can read these charts, and we hope to obviously get these charts even better than they are, once you can read a chart and you know what's going on, then what we say is your skill as a trader has to kick in. And then you'll be well on your way to becoming a professional trader and earning a living from the market like this. So that's stopping volume. Right now, market goes up on that response until we get a sign of weakness suddenly appear up here. Look, this is Friday's action. Supply here. So read these dialog boxes. There's a lot of information there. They were completely re-edited by Philip Tristan, and he's done a fantastic job there. Right, the market falls on that, but lo and behold, as another signal suddenly appears on the low. Well, excuse me. Now that says a potential selling climate. Well, the reason why it said that is because you've got this down move, but look at that volume. Look at that massive volume there that's coming. Pardon?
Where the market opened, of course.
Yeah, that's true. Peter's just chipped in. Peter's sitting by the side of me. And of course, that's when the US market opened. Now, don't forget, this volume all along here is Globex. But as soon as the market kicks in, the S&P pit opens up, then you get this terrific surge in volume. But it still seems to work, look. Right? So, in other words, really, you can see there, professional money, when they're buying, they have to buy on a down bar. Right? So there it is, a beautiful example there. Now, once you're in the market, what we recommend, or I recommend, is that you follow what we call the simple trending system. And that works because once professional money has got some sort of position in the market, they have to make sure that the bull move continues in such a way that it doesn't encourage other traders to sell, right? And how to do that is that if the close of the bar is higher than the close of the previous bar, right, it produces a blue bar, look, and that tells you the thing's trending up. This will keep you in the market a lot longer than you normally would do, because it's very, very easy to be shaken out of a trade far too soon. I've had many people say, oh yeah, Tom, I got in on the low, but I sold far too early. I could have made a lot more money. But this gives you some idea about how to stay into the market. Now move the chart forward, look. So we've got this trending system, look, blue bars up. Now, you allow, the system will tell you, you allow for one down bar, right? And that down bar should be on low volume. And when we say low volume, because we use relative volume, it's low relative to the previous two bars, two volumes. Don't forget the volume at the bottom is the amount of activity that's taking place. And we know that it's professional activity creates this volume, this activity. Okay, so when you see this low down bar and low volume, look, you know the market is still wants to go up. So you stick with it, look, up, up, one down bar again. And again you look at the volume, and again the volume is low, look. So you know it's potentially still bullish, look. So in other words, it'll help you stay in your trade a lot longer. It's very easy to get shaken out of a trade. Up, 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 up. Right, still going up. Now, I'll just move the chart forward a bit. Still going up. Now, right, up. Now, this is the first. That's it, yeah, I've got lost a bit there. The first two down bars that we've seen. So it's just a slight warning, look, that everything might be quite so rosy. But we look down at the volume, and lo and behold, the volume is still low as these markets fall, look. The computer colors it pink for you to tell you, yes, relatively speaking, the volume relative to the previous two bars is low. And we know that means that the professional money in there are not selling. That's why the activity is low. So it goes up, 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 one down bar. So we look at this, it's getting slightly more, look, slightly more supply. Again, just about the same, look, up, up, up. Now this is the close of Friday. Now the thing is, look at this tremendous high volume on this bar. It's gone up. Not only is the volume very, very high, but it's also the spread has narrowed. It's also closed just off the top. This is supply without question. However, on saying that, it is fairly level with probably some previous highs here, and there may be some absorption there of selling. What I mean by that is that whenever the market reaches a level where there may be some, here, look, we draw a line across there, this could be a potential area people want to sell, right? And sometimes you will see very high volume there, and if the professional money are still bullish, they will be prepared to buy that. Now, whether that's buying or not, it certainly looks like supply, although there is what looks like a test on the previous bar. I'm sure Gavin's told you all about testing. However, there is some supply here. Now, the final 15 minutes, look, it's shot up, a widespread up, and the volume is still very high. I would say that the supply there, and we've also got some sort of signal here, look. Can you click on that, Peter? Those boxes are, yeah, well, we know it's supply coming in, we know that. But does the computer know that? Yeah, the computer knows it. So the computer knows that we've told it. Now, don't forget, a lot of these signals are years work. So we know it's not going to change. And it'll be the same in 10 years and 20, even 100 years' time. They'll still be working. And you hear people say, oh, well, that's very well. But what about if the market conditions change? Well, if the market conditions change, then all that means is that the volume and the relative spreads change. So as far as VSA is concerned, it's self-adjusting. It does not, because we're not using formulas. That's why we don't use an open price, because open prices are usually used because of the formulas. But we don't need that. We know the markets work on supply and demand. And there's definitely supply present at the close of the S&P 500 on Friday, last Friday. You would expect that market to, well, you have to read it as it unfolds, and especially Mondays when they open up. If they start testing the market on Monday, in other words, if you see a sudden down bar, especially if the spread is narrow as it goes down, especially the volume has to be low, right? The computer needs to color it pink, right? That's an indication that, yes, there was some supply there, but that's been absorbed. Don't worry about it now. This market wants to continue up. But on the other side, if you see an upthrust, which is orchestrated by market makers and pit traders, or market makers especially, they know the market's weak. They know they're holding it up as best they can so it could sell more into any wave up, in other words, any wave up that makes the market go up. They want to sell into that. They know perfectly well the market's weak, and some may hold it up longer than other times. But when you see a sign of weakness appear, something like this, and then you see what we call an upthrust. It looks like a telegraph pole up on top of a hill. It goes up, right? you could be on good news. It collapses on the low, and the volume can be low or it can be high, but usually it's low. In other words, no demand. As they mark it up, you see the volume is very low because the professional money know that it's just been marked up and they're not interested in participating in any higher prices because they know the market's weak. And that's a sure sign. This is a time to sell or go short or whatever. Now, Gavin, is there anything else you'd like me to talk about?
Yes, Tom, just bear with me a sec. If you could actually talk about two signals for me before we go here. We've got about another 5 minutes before we have lunch. I said to the group earlier, I've shown them two signals. One of them is the end of a rising market, which you know is my favorite. In fact, I've made more money with you and I trading that than probably any other signal. Also, bag holding at the bottom. The question did come in, and I raised it, is why don't you have the end of a falling market instead of bag holding? Perhaps you can answer that one. But the other thing that I think we'd like to know is, I've said that really in Trade Guide we don't give buy and sell signals per se. We show the imbalances of supply and demand, just like Wyckoff did. But if there's two signals that are as close to a buy and sell signal in the software that I would say there is, both those signals are definitely, if you know, traders listening out there on the internet, the lovely group we've got here, if they just took away those two indicators and looked for those, you couldn't really go far wrong, apart from the upthrust, which is a great short. Just talk to us about those for 5 minutes, Tom. That would be great.
Well, as Gavin said, the favourite one is the end of a rising market, and the reason why we call it the end of a rising market is that, first of all, you have to see a bull move. You have to see the market going up. Something like the chart you're looking at right now, it's obviously gone up, right? Now, what that means is that it's made the market vulnerable, right? It's made the market look nice for professional traders to say, right, now's the time I'm going to take my profits, and I might even go short because the market is vulnerable to now coming off because we've got this move behind us. And right, so okay, so imagine you're a professional trader. You have to sell into a rising market. You can't sell as the market's falling, because if you try that, it'd be disaster, because other professionals will pile in and sell, and they won't let you make any money at all. You probably finish up losing money. But so, right, what they've got to do, they've got to usually orchestrate a gap up move, right, on good news. You see some sort of good news. The euro problems are all finished. The employment rates shot up. You know, any sort of good news. It's not the news that's moving the market. It's the professional money manipulating the market around the news. And that's why they advertise the news events so clearly for you. You know, I know if I ask Rita sitting here, what's the news? And she'll tell me all the news events that are coming out probably next week. Now, you'd be very naive to think that the professional money were not fully aware of what those news events were going to contain. They probably have written a lot of it, because like the politicians, if they want to know something about the market, they go cap in hand to the stock exchanges, and ask them. Now, as I said before, it's like putting Dracula in charge of the blood bank, you know, if you do that. So to sell all your, as much holdings as possible, you know the news is coming out. On the news, it's gapped up, right? But you, as an observer or chart reader, right, notice that the spread is narrow. And you also notice that the volume is very, very high. The computer will probably call it ultra high. Now, that can only mean one thing. Professional money are selling into the buying. Every time buy orders come in from outside, right? They say, right, okay, you want to buy, we'll let you have it. And they transfer their holdings over to the buyers. And you know that's going on because the narrow spread up bar, something must have capped the top end of the market, must have put a cap on it. Nothing else can cause that. Don't forget, everything we tell you is logical and straightforward. We don't claim to have secrets and all this nonsense, you know. And so when you see an up bar gapped up on narrow spread, you know that something must have capped the top end of the market, especially if the volume is ultra high. And that means that the professional money are selling. And they know how what we call herd behavior as well. They know that there's a lot of people in there that haven't bought. They're not in on this bull move. And they see this thing going up day after day, week after week even. And they're getting a bit fed up and not being in. And when the good news comes out, it's hell with this, I'm going in. And they tend to buy. And this is also well known amongst professional traders. It's what we call herd behavior. But that's what's going on. And as far as then, as we know, as far as we're concerned, the market has now become weak. And Gavin's made many successful trade on that. And there are other aspects to it which we've probably told you somewhere about how they can test that. But that's a serious sign of weakness. Now, because we're talking about a principle here, which we know is right, because the computer comes up automatically with the signal, and I've very, very rarely seen it's not correct. Very rarely. Because we're talking about principle, then the exact opposite must be true as well, mustn't it? In other words, if you turn the thing upside down, if the principle is correct, then it will still be correct. But this time you see a gap down bar. And you will see in the background as well on your chart, probably some stopping volume or sign of strength in the background. Some extra bad news has come out. And on that news, they've done exact opposite to what they would do at the end of a rising market. They've marked it down, right? The spread is narrow, and the volume will be ultra high. This is what they call bag holding. It was a Wyckoff term. It wasn't mine. I was just using Wyckoff terminology there. And he called it bag holding. And what he meant by that was professional money have seen the opportunity to buy at low, cheap prices. And he said it's like they hold up the bag and say, okay, if you don't want it, I'll have it. And all the trading poured into this open bag, and that's why he called it bag holding. I didn't come up with that. It was Richard Wyckoff 100 years ago. And what's interesting about that is that the principle is still very, very sound. Now, you're not going to see bag holding every 5 minutes, I tell you. But the thing is, when you do see it, then you know definitely that you're in for a bull move. And you can trade on that information very successfully. But so bag holding is the exact opposite to end of a rising market. Bag holding, of course, they gap it down and the spread is narrow. Now, exactly like the opposite to the top, for a down bar to be on a narrow spread, there must have been a floor put under the price. In other words, the price must have reached a certain level, and at that level, all the professionals said, right, I'll have it, we'll take it, and that creates a narrow spread down bar, and it's a very strong sign of strength. Very strong, but you won't see that every 5 minutes, I can assure you. But the thing is, as a Wyckoff expert, if it happens, when it happens, you should recognize it immediately, and then your skill as a trader has to kick in. It's not easy trading, because, see, even if you witness a bag holding event, if suddenly you're sitting there in the morning, and the market's plummeted down. It's churning away at very high volume. All the news is bad, right? The TV programs and everything are telling you that it's got to be a hell of a lot of selling going on. What else can they? They don't know. They say, well, it has to be selling because it's high volume and the bar's down. So it can't be anything else but selling. But you know differently. It's actually buying from the professional side of the market. And that's why you will easily get misled. In other words, you can witness bag holding, or you can even witness end of a rising market. But are you geared up to receive that information as it is? In other words, overriding all the apparent bad news, or good news, whatever it is. And that's part of your skill as a trader. Because in hindsight, you can look back and say, oh my God, look, if I'd have bought that or sold that, look what I'd have made. But you would hesitate because you're not geared up for it. Why should you be geared up for it? Normally, you won't be geared up to buy something that plummets down in the morning, volume is very high and the news is very bad. You say, well, that doesn't make sense. I'm not going to buy on that. But that's the difference between a professional trader or a Wyckoff trader knows what he's talking about and a I call them amateurs. Gavin?
Master, that's superb. You sound like you're on fine fettle, to say the least. You sound like your trip to the hospital didn't do you too much harm. We're just about to have lunch here. We've got a lovely spread here. But you sound well, Tom, which is good to hear.
Okay.
Can we all give Tom a round of applause, just so he can hear? So, there we go. Well done, Master. Yeah, you can take a bow now. We're all imagining you there.
Thank you very much.
We're going to break for lunch here. We're going to be back with you at 1 p.m. Chicago time here. It's now 12:09. We've got a lovely spread here. In fact, it's an awful lot of food to eat. So we'll be fully stuffed. But we've got to stay awake because we've got David Weis on after lunch. David's not going to be eating any lunch, he's told me, at all, because he wants to be on... Oh, sorry, maybe I mistook that. Okay. A little bit. Okay, right. And so we'll see. I hope you're all enjoying it so far. I've got tomorrow... I've got a lot. We've got to one of my slides there that's going to lead very nicely in to how we use trigger numbers, and then I'm going to give you some very specific setups in my presentation tomorrow afternoon, which goes on for a couple of hours. So after lunch, we've got David Weis, and then wrapping up, we've got Steve Phillips, who's going to be really getting into some VSA stuff. So great stuff, everyone. Hope you're all enjoying it. How do we send you sandwiches, Fiona? I'll pack one up and put it via FedEx. It's to Australia, and you can see if you can get it, but I don't know how we're going to manage that one. All right, everyone, we're having lunch. We're back at 1 p.m. Chicago time.